Good morning, guys. I have decided to record another class on the same day. So in the previous class, guys, of transfer pricing, I told you about why transfer pricing is important as such, guys. What is the utility of transfer pricing system? Will transfer pricing system have an impact on the profitability of the entire organization? I'll not start with the scratch as such, but just a overview as such, of what we discussed in the previous class. I told you guys that there is certain amount of decentralization in every organization, which will obviously be dependent on their organizational structure. That in turn will result in responsibilities being assigned to different individuals, different departments. And if responsibilities are assigned, you will want to measure their performance as such, guys. Measure their performance, first thing. And that can either be based on the amount of revenues that they're generating, cost, profit, or investments. Perfect. There can also be transactions between different divisions as such, guys. And this transaction will lead to a concept called as transfer pricing, the price that one division will charge to the other better for goods and services rendered. Not just goods and services, they can also be payment for intellectual property rights. So they can be loans at subsidized rates better from one department to the other department. Now every departmental head beta would want to maximize their profits as such, guys. Also, guys, at the same time, do not forget goal congruence is very important. You will have to keep in mind that achieving the objectives of the organization is far more important than achieving your objectives. Your individual objectives should be aligned with the objectives of the organization. Understood, sir? इसके बाद में बेटा I told you as to what is the aim of transfer pricing system, what is the utility. Utility beta is that it helps us beta in performance measurement. It will help us in deciding the compensation of employees, guys. It will help us in allocation of resources. We can plan our taxes, all of that beta. And then again, guys, the concept of fair value as such, guys, is transfer price guys, actually equal to fair value. Not necessary, but it would depend upon bargaining power. Then, guys, will transfer pricing have any impact on the profitability of the organization? I said as long as the output is not getting affected, as long as the output is not affected as such, but transfer price will not have any impact on the profitability of the company. However, because of transfer price as such, guys, if the output is getting affected, as such, guys, then transfer price will certainly have an impact on the profitability of the organization. So what are the different methods of transfer pricing? First one beta is market-based transfer price. Market-based transfer price beta is basically used when there's a ready market for the product that is being transferred by one division to the other division. Here the transfer price beta should be your market price plus or minus adjustment for cost savings, guys, on account of internal transfers or incremental expenditure that is being incurred. Advantage beta is that market price is unbiased as such beta. This will result in better evaluation of performances as such, guys. There's proper demand and supply constraints in the market that determines the market price. And then, guys, every organization will strive to achieve their own, will improvise their performances. Disadvantages beta is market. What if the market does not exist? What if you have too much of idle capacity as such, guys? And then what if the market prices are not fair values as such, guys? There's too much of oversupply in the market, resulting in a very low market price. Behavioral consequences of market-based transfer price beta is simple, that market-based transfer price will obviously result in better performance as such, guys. All the organizations would strive to improve their own profitability by cutting down on cost. They know better that market transfer price is fixed on market price, so the only way better that they increase their profitability beta is by implementing cost reduction and cost control techniques. Understood, sir? After that bit, I said shared profit in relation to cost. You determine what is the best level of output for the entire organization as such, guys, and then start distributing profits in the basis of cost. Cost based में बेटा I said cost based, guys. Advantages भी है, disadvantages भी है बेटा for cost based. Advantage is such बेटा for cost based is that it is just based on your internal information. Information is easily available as such, guys. Internal cost targets. Disadvantage beta is that there might not be any improvisations as such, guys. There might not be any efficiencies implemented because you know better that the cost burden is being passed on to the other division. It can be marginal cost, which is used better when there is idle capacity, but marginal cost beta would always result in a loss, guys, to the selling division, guys. So they will never be motivated as such better to make additional investments or to expand the production capacity. If it is based on full cost as such, better standard cost as such, guys, performances can be evaluated based on your comparison of actual cost beta with the standard cost, actual cost beta with the standard cost. Disadvantage of standard cost beta is that your divisions are only working as cost centers and not working as profit centers. Behavioral consequences. No one is implementing cost reduction, guys, under standard cost. They're only implementing cost control. So there's no real cost reduction as such, beta. There are no real cost savings under standard cost system. Understood, sir? And then, guys, after that, beta, full cost. Under a full cost as such, guys, when we talk about full cost, advantage is better to the selling division is that they're recovering their entire cost. Disadvantages, it will always result in a loss. Behavioral consequences, not necessary better that full cost should result in optimal decision making. I gave you an example better where full cost resulted in suboptimal decision making from the viewpoint of the organization. Yes, yes. And then finally, beta, we did cost plus markup, guys. Advantage, beta, to the selling division is always results in profit. Disadvantage is such, beta, is that certain expenses which are not actually incurred on internal transfers as such, beta, might be taken into consideration. And then, guys, a behavioral consequence is simple. Then there is no cost reduction. There is no cost reduction. The most important one, beta, is the fourth one now. Negotiated transfer prices, shadow pricing. Negotiated transfer pricing as such, beta, that is shadow pricing. Negotiated transfer pricing or shadow pricing. This is the method, guys, where there is actual autonomy as such, beta, given. This is the method, guys, where there is actual autonomy, beta, given to the divisional managers. To the divisional managers, guys. Matlab, you are free to decide whether you want to procure beta from our own internal divisions or whether you want to procure it from an external supplier. Boss, tum decide kar lo. We are giving you full independence. It will purely depend on your negotiations. We are not telling you that you should. The top management is not deciding a transfer pricing system. The top management is not telling you that, boss, you'll have to transfer based on market prices or you have to transfer based on sharing profits in relation to cost or transfer based on cost. तुम तुम्हारा देख लो, you see for yourself, you decide for yourself as to what is better as such, beta, you mutually decide. One of the biggest disadvantage of negotiated transfer pricing, beta, is that the transfer price as such, beta, would depend upon the negotiation skills of a particular manager. What if the manager of a particular division as such, guys, is not good at negotiations, not everyone has negotiation skills, guys. See, when we qualify as chartered accountants and then we are offered jobs as such, guys, there is certain amount of negotiation skills that even we are required to possess. Someone might say, beta, that you will be given a salary of 6 lakh rupees. You're supposed to justify as to why you deserve a higher salary. That will be your negotiation skills, guys. So यहाँ पे बेटा it will purely depend as such, guys, beta, on the basis of negotiations as such, guys. Advantage, beta, is yes, full independence is given. Disadvantage, beta, is that you need a lot of information for this. You need a lot of information, guys. See, if I want to negotiate as such, guys, I should know what is the cost that the other person is incurring, what is the surplus capacity that he has, what is the idle capacity that he has, what are the prevailing market conditions. Only then, beta, my negotiations would work better. Imagine, guys, if I know what are the weak points of your business and I use those weak points as such, beta, blatantly to tell you that, boss, I know these are the conditions. I know that you have a production capacity of 1 lakh units and you do not have a market demand of more than 20,000 units. That is why I will offer you only this price. See, you need a lot of information there, guys, for the purpose of proper negotiation. यहाँ पे बेटा negotiation में ऐसे हो सकता है बेटा that decision making, guys, is going against a company. This is where the top management has to interfere. The top management will have to interfere as such, guys. One behavioral consequence as such, guys. See, first thing, beta, is that yes, a lot of independence is given as such, guys, so that they directly, work towards the organization. Work towards the organization goal, but guys, again, top management's interference might be required as such, guys, if the decisions are not in the interest of the organization. समझ में आ रहा है? हाँ सर. So guys, imagine better that I am a selling division and you are the recipient. Guys. I do not have a surplus. I do not have, guys, full capacity operations right now. I have a surplus capacity. My incremental cost of manufacturing a product is 6 rupees, guys, but then I sell it in the market at 10 rupees. My incremental cost of manufacturing a product is 6 rupees and I sell it in the market at 10 rupees. But I know that I will not be able to sell the entire produce at 10 rupees in the market, guys. You are offering me only 7 rupees. You are offering me 8 rupees as such, guys. You are offering me 8 rupees. You are telling me that I can buy it from the outside market at 8 rupees, so I'm offering you only 8 rupees. And I tell you, no, I will not give you at 8 rupees. So you end up buying it from an outsider at 8 rupees. तो अब क्या हो रहा है बेटा? I could have made that profit of 2 rupees. From the organization's viewpoint, beta, 8 rupees is flowing out of the organization. 8 rupees is flowing out of the organization. Now this is not decision making from the viewpoint of the organization. ये गलत है बेटा. This is wrong. This is not decision making from the viewpoint of organization as such, guys. The organization as a whole. Forget this organizational boundaries, beta. Think of this like a make or buy decision. Forget organizational boundaries, beta. Think of this as a make or buy decision. Do you remember make or buy decision? To take a make or buy decision as such, beta, you're simply supposed to compare your relevant cost of manufacturing with the external supplier price. और कुछ नहीं है बेटा. Relevant cost of manufacturing with the external supplier price. Your relevant cost of manufacturing here is only 6 rupees. Now instead of manufacturing at 6 rupees, you ended up procuring it at 8 rupees. Instead of manufacturing this component at 6 rupees, you ended up procuring this component at 8 rupees. Isn't that incorrect? Yes sir, that's obviously not fair. This is what you should know guys. So yes, beta, negotiations can result in suboptimal decision making. So there will be interference of the top management required as such, guys. There are two conflict, guys, conflict, two pricing methods as such, beta, for resolving conflicts. One is called as two-part transfer pricing system. The other one is dual rate transfer pricing system. We'll come to that also, guys. ये तो समझ में आ गया ना बेटा सबको? I hope you all understood what is negotiated or shadow pricing as such, guys. Negotiated or shadow pricing. Uh, it can result in suboptimal decision making. Perfect. ये देखो बेटा, prices, हाँ, in order to have an effective system of transfer pricing, the following points should be kept in view. In order to have an effective system of transfer pricing, you should keep the following points in. Not in every organization, beta, full independence is given. Full independence is given, guys, that you can do whatever you want to. Most of the organizations will say that no boss, we do not care. You will have to procure it only from your other entity in the division as such, guys. And at this price, this is your transfer price, either market price or either cost plus or whatever, guys. So negotiations, prices of all transfers in and out of a profit center should be determined by negotiation between the buyer and seller. Negotiators should have access to full data on alternative sources and markets and to public and private information about market prices. Buyers and sellers should be completely free beta to deal with outside the company. You give this independence to them. By you have access to all the information inside and outside the organization, all negotiations as such beta, then yes, it will be effective. It will be effective. Otherwise, it is not going to be effective. Yes, sir. Understood? Yes, sir. All of you beta, let us write in your concept book beta. Concept book. Fourth method, guys. Negotiated transfer pricing. Negotiated transfer pricing. Bracket mein beta, shadow pricing. Negotiated transfer pricing. In brackets beta, shadow pricing. Shadow pricing, guys. Negotiated transfer pricing beta, in brackets, shadow pricing. Shadow pricing. Okay sir, देखो बेटा, under this method, autonomy is given to the managers. Autonomy is given to the managers. Under this method, autonomy is given to the managers. Autonomy is given to the managers. Autonomy is given to the managers to decide if they will procure internally, to decide if they will procure internally, to decide if they will procure internally or procure from outsiders, or procure from outsiders. Similarly, better the selling division can decide, guys, whether they want to sell internally or sell in the outside market. Similarly, the selling division can decide. The selling division beta can decide if they wish to sell, internally or in the outside market, or in the outside market. If they wish to sell internally as such beta, or in the outside market, or in the outside market. Yes guys, I hope you're all doing this better. Under this method, autonomy is given to the managers to decide if they will procure internally better or procure from outsiders. Similarly, the selling division, guys, can decide if they wish to sell internally or in the outside market. The transfer price will depend on the negotiation skills. This is one of the behavioral consequences, beta. Will depend on the negotiation skills. Advantage is the autonomy given to managers. This is the biggest advantage. Autonomy given to managers. Disadvantage beta of this method. Disadvantage of negotiated transfer pricing. Is that beta, there is extensive information required. Extensive information. You need to have all the information as such beta required. Matlab guys, what is the amount of external demand? What is the amount of external price? external demand कितना होता है, how much is your external price, how much is your selling and distribution cost, and so on. So there's a disadvantage as such beta there. Behavioral consequences. Behavioral consequences beta. Under that, guys, you will write better. First thing better is that yes, of course, it improves efficiencies. It improves efficiency. But the problem better is that it can result in suboptimal decision making. Can result in suboptimal decision making. This can result better in suboptimal decision making. I hope you were all writing it with me only, guys. हाँ सर आप ही के साथ लिख रहे थे. ये देखो बेटा हुआ क्या सबका. I'll zoom in, guys. Check if you're all done with this. I'm zooming in better. Part better here. We will write an example to prove the behavioral consequence point, guys. We will write an example better here. What is that example? Say, guys, the marginal cost beta, incremental cost as such, guys, to division A beta. Division A is 6 rupees. Division B beta can procure beta at 7.5 rupees. Division B beta can procure at 7.5 rupees beta from external market. Division A does not want to transfer. Division A has spare capacity. Division A beta has spare capacity. उसके बाद बहुत spare capacity है बेटा. But Division A does not want to transfer below 8 rupees. Does not want to transfer below 8 rupees. Below 8 rupees. Whereas beta Division B beta can procure at 7.5 rupees. 7.5 rupees. Now if you look at this information as such, guys, if Division B procures from external market, if Division B beta procures from external market, the company as a whole beta will lose 1.5 rupees. If Division B beta procures from external market, forget the fact beta that these two are, sun lo beta. If Division B beta is actually procuring from external market beta, company as a whole will lose 1.5. The company as a whole beta will lose 1.5. Company as a whole beta will lose 1.5 rupees. Yes, sir. Forget the fact beta that they're two different divisions as such, guys. Ultimately they're part of the same organization, but it's a simple make or buy decision. A simple make or buy decision beta. Forget organizational boundaries. Make or buy decision, guys. So here beta my variable cost of manufacturing is the relevant cost 6 rupees and the external supplier price beta is 7.5 rupees. Undoubtedly beta the organization is supposed to manufacture this. Undoubtedly the organization is supposed to manufacture this. Isn't this suboptimal decision making? हाँ sir, ये तो suboptimal decision making हो गया. This has become suboptimal decision making, sir. Here, this is what I was talking about beta, that this would result in suboptimal decision making. Please copy, guys. All of you better copy this example beta, which proves that negotiated transfer price can result in suboptimal decision making. Yes, beta. I hope you're all done with this. I hope you're all done with this. Yes, beta. Chalo, guys. This is the answer to question. Sorry, this is an example for negotiated transfer pricing, guys, or shadow pricing. I hope you've written that, guys. So the point that you're supposed to remember, guys, for effective transfer pricing system, the points are based on negotiated transfer pricing only, beta. Based on negotiated transfer pricing. First most important beta for based on negotiated transfer pricing, guys, is yes beta, 1 second. Yes beta. कभी कभी behind the scenes भी तुम्हारे को बताना बेटा. Suddenly my son will come into the recording and he'll be like, I want to teach today, and he'll talk something random beta all of a sudden, and the two words that I will for sure say beta at the beginning whenever he pretends that he's recording is yes guys. I do not know how he guys got to know that. He keeps listening to me, I believe. So he will start the class like this, yes guys बोल के बोलेगा, and then he will do something or the other. But I'll talk about solar system, he will talk about his gecko's garage as such beta, his toys, something. So guys, your effective transfer pricing beta based on negotiated transfer pricing. First thing beta is all transfers should be based on negotiations. All transfers based on negotiations compulsorily as such beta. No favoritism. Access to full information, guys. Access to full information beta. All of them beta should have access to full information. Just external demand, internal capacities, external demand, internal capacity beta, selling and private expenditure. And then guys, free to trade with anyone. Free to trade with outsiders. You are giving them total independence as such, guys. So let us not restrict the independence that is being given to them. Give them a total autonomy as such, guys. Give them a total independence. Or let them deal with whomever they want as such, guys. They can always deal with outsiders. Okay? Yes, sir. So just write these points better. Write these points just in case they ask, guys. All of you better write these points. Effective transfer pricing. Yes, beta. I hope you're all done with this. Now, guys, we'll discuss one more concept as such, beta. Write in the concept book and then go start solving questions, guys. इसके बाद में guys majority questions only. Transfer price and goal congruence. Transfer price and goal congruence. Or you can say beta transfer pricing for the purpose of decision making. Transfer pricing for the purpose of decision making. Forget transfer pricing, guys. For the purpose of decision making. Okay. Forget transfer pricing, better try recollecting make or buy decision. Try recollecting make or buy decision, guys. Under make or buy decision, better I told you that the decision would be based on relevant cost of manufacturing as such, guys. Just for your understanding, beta, note, if it is make or buy decision, beta, we always used to compare our relevant cost of manufacturing as such, guys. You will always compare the relevant cost of manufacturing. This relevant cost of manufacturing is such, beta, relevant cost of manufacturing can be, beta, your variable cost per unit. It can be your variable cost per unit as such, beta. It can be any specific fixed cost. It can be any specific fixed cost, beta, if any. And plus, beta, if there's any amount of contribution that you have to forego as such, beta, because you have to manufacture this. What if you do not have spare capacity as such, beta, and you have to forego contribution? So that contribution foregone also will come into picture, guys. So compare relevant cost of manufacturing as such, beta, with supplier price. This is what, beta, we have learned under make or buy decision. We've always compared our relevant cost of manufacturing, beta, with the external supplier price. If relevant cost of manufacturing is less, it is better to manufacture. If external supplier price is less, it is better to outsource. So if there are multiple components, we have compared variable cost of manufacturing with external supplier price. We have computed savings per unit. We computed savings per limiting factor, and then decided on what basis should we allocate our limiting factor. Recollect, remember, guys, same thing, guys. Now same concept, beta, same concept. Your minimum transfer price and maximum transfer price, beta, is what they will ask in any examination. Minimum transfer price and maximum transfer price. Minimum transfer price, beta, is from the viewpoint of the selling division. What is their cost? Minimum from the viewpoint of selling division. Sunna, beta, वरना मार दूंगा. Minimum transfer price, beta, is from the viewpoint of selling division. This is termed as, beta, the wording that they use, beta, is additional outlay per unit plus opportunity cost per unit, if any. What is your additional outlay per unit, beta, plus what is the amount of opportunity cost, if any, as such, guys. Opportunity cost, beta, if any. So this, beta, would be what is your marginal cost per unit, beta, plus other expenses, if any. Matlab specific fixed cost, guys. And of course, beta, opportunity cost is opportunity cost. If there is no opportunity cost as such, beta, the minimum transfer price for the purpose of decision making, matlab what is good from the viewpoint of the entire organization. As such, guys, that we will decide, beta, on the basis of minimum transfer price. Maximum transfer price, beta, I hope you're all understanding this. Maximum transfer price, beta, is from the viewpoint of purchasing division. यहाँ पे, बेटा, they use a concept called as net incremental margin, net marginal revenue, right? Net marginal revenue. So they write, beta, maximum transfer price as lower of net marginal revenue and external buying price. Lower of net marginal revenue, guys, and external buying price. Lower of net marginal revenue, beta, and external buying price. That is your maximum transfer price. ये क्या है सर समझाने में? सुनो, guys. Please pay attention, guys. All of you, beta, please pay attention. Example. Division B needs a component, beta, that is manufactured by, needs a component manufactured by Division A. Division B, beta, needs a component manufactured by Division A. Division B का, beta, selling price is say 200 rupees, and their cost as such, beta, marginal cost, I would say, beta, marginal cost as such, beta, say they will have to incur, say, beta, 120 rupees plus transfer price. 120 plus transfer price, beta, whatever is a component A. ठीक है? Net marginal revenue, beta, net marginal revenue is like NRV. This would be, what is the selling price of Division B, beta? Selling price of Division B is 200 minus what is the incremental marginal cost. After we supply to them, what is the incremental marginal cost that they will have to incur? So they will have to incur 120 rupees. So this is their net marginal revenue. Under no circumstances, beta, under no circumstances will division B beta offer you more than 80 rupees. If he's offering you more than 80 rupees as such, guys, he will say I am losing. I am losing as such, guys. Or beta say if division B can procure, if division B beta can procure at 60 rupees only, if division B beta can procure at 60 rupees, he will not offer more than 60 rupees. अब सुनो बेटा, I am transferring a division, I am transferring a particular component to you guys. Okay, I know beta on this component you are incurring an incremental expenditure of 120 and you will get 200 rupees. So the maximum incremental revenue that you are getting beta is 80 rupees. So you will not offer to me anything more than 80 rupees. You will not offer anything more better than 80 rupees. Or if you have an option of buying from outside market at 60 rupees, you will be like, why should I give you 80 rupees? I will directly buy from the market at 60 rupees. I will directly buy from the market at 60 rupees. Usually, beta, they will not give net marginal revenue in questions. Usually, you will not see net marginal revenue in questions as such, guys. But however, remember, this is only for the purpose of goal congruence. This is only for the purpose of decision making. I repeat, this is only for the purpose of goal congruence. This is only for the purpose of decision making. Minimum transfer price is marginal cost per unit plus opportunity cost. Very clear, sir. Plus specific fixed cost, if any. Maximum transfer price is from the viewpoint of purchasing division. नॉर्मली बेटा मेक और बाय डेसिशन में अपन क्या लिखते हैं, सप्लायर प्राइस. यहां पे भी सप्लायर प्राइस ही है बेटा, बट वन न्यू कॉन्सेप्ट दैट इज नेट मार्जिनल रेवेन्यू. नॉर्मली अंडर मेक और बाय डेसिशन, normally under make or buy decision, we write guys that decision should be taken on the basis of relevant cost of manufacturing compared beta with supplier price. Now this relevant cost of manufacturing is becoming your minimum transfer price. This supplier price is becoming your maximum transfer price. Maximum transfer price. However beta, maximum transfer price is not just supplier price, it is lower of net marginal revenue beta and supplier price. Lower of net marginal revenue beta and supplier price. समझ में आ रहा है क्या बोल रहा हूँ guys? Net marginal revenue to division B, guys. What I'm trying to tell you beta is division B will not pay more than 80 rupees. Will not pay more than 80 rupees. If it pays more than 80, if it pays more than 80 beta, division B will incur a loss. If it pays more than 80, division B beta will incur a loss. Will incur a loss. This is first beta. Net marginal revenue. Net marginal revenues, what is the incremental revenue that they are getting beta and incremental cost that they're going to incur from that point of time. However beta, if division B has an option, if division B beta has an option to buy from external market at 60 rupees, buy from external market at 60 rupees, if division B beta has an option to buy from the external market at 60 rupees as such guys, division B will not offer more than, division B will not offer more than 60 rupees. Will not offer more than 60 rupees. However, if division B beta has an option to buy from external market as such guys, division B will not offer as such beta more than 60 rupees. समझ में आ गया? हाँ sir, आ गया. So basically beta, your maximum transfer price cannot be more than, cannot be, it's maximum transfer price as such beta should be lower of net marginal revenue and external buying price. External buying price beta is supplier price. When we use the word external buying price beta, it is supplier price. So we will all remember relevant cost of manufacturing as minimum transfer price. We'll remember supplier price as maximum transfer price. But along with the supplier price, we are now bringing in a new concept called as net marginal revenue. Along with the supplier price beta, we are bringing in a new concept called as net marginal revenue. Why will they want to incur a loss? Why will they want to incur a loss? They will not want to know beta, इसीलिए ऐसा आएगा. Majority of questions guys, net marginal revenue will not come. Majority of questions beta, net marginal revenue will not come. ठीक है, ये कॉपी करो बेटा. I'll give you a lot of examples. Do not worry, we are going to solve a lot of questions. It is absolutely fine. Even if you have a little confusion at this point, there should not be any confusion. Even if you have a little confusion, guys, do not worry. We are going to take a lot of examples, a lot of questions, and that will give you perfect clarity on this. All of you better copy this: transfer pricing and goal congruence. Transfer pricing and goal congruence. होप यूर ऑल कॉपिंग बेटा प्रॉपरली, ठीक से करना बेटा सब लोग. Are you all done? Here guys. हो गया? All of you write this conclusion guys. I hope you all understood this. I'm assuming that you're all done with this. Always remember better. Always remember guys, if maximum transfer price is less than minimum transfer price. Note better, if maximum transfer price is less than minimum transfer price, internal transfers will not take place. There will be no internal transfers. Matlab, it is not viable to transfer internally as such guys. It's not viable. There'll be no internal transfers. That fellow's opportunity cost is more. We cannot pay more than a particular price as such guys. Say the minimum transfer price is 100 rupees, but maximum transfer price is 60 rupees. कहाँ transfer करेंगे बेटा? किसको transfer करेंगे? Transfers will not happen as such guys. Transfers will not happen guys if maximum transfer price. Say guys, if minimum transfer price is 100 rupees based on opportunity cost and all of that beta, and maximum transfer price beta based on your receiving division, purchasing division is 60 rupees beta. So there'll be no internal transfers. very clear beta, there will be no internal transfers at all. ठीक है? It is not viable guys for the other division to manufacture output only as such guys, so he will leave it, or he will buy from the external market. He will buy from the external market. Yes sir, understood. Please write this note also as such, but it's an important point wherein we compare maximum transfer price beta with minimum transfer price. So what are you supposed to know beta is that minimum transfer price is equal to your relevant cost of manufacturing, which would be beta additional outlay per unit plus opportunity cost per unit. Additional outlay per unit will be marginal cost per unit plus whatever is the amount of additional fixed cost. And your opportunity cost to add करना ही पड़ेगा. Maximum transfer price will be lower of net marginal revenue and beta the amount of external supplier price and the amount of external supplier price. यहाँ पे लिखना है तो लिख सकते हो बेटा, net marginal revenue बेटा is selling price of division B minus incremental cost to division B. After you transfer as such beta, what is the additional cost that they're going to incur? After you transfer as such beta, what is the additional cost that you are going to incur guys? I hope you're all clear about this. Yes beta, I hope you're all clear about this. ठीक है? Now guys, let me just give you a couple of examples and then we will start off beta. Examples for minimum transfer price. Say guys, division A beta is selling division. Division A beta is selling division, okay? Selling division. Case 1 guys, case 1. There is spare capacity available. Spare capacity available, okay? No incremental fixed cost. No incremental fixed cost. Variable cost of manufacturing. Variable cost of manufacturing beta is 6 rupees. End of discussion beta. Your minimum transfer price should be 6 rupees. Your minimum transfer price should be 6 rupees. There is spare capacity available, so but obvious beta there is no opportunity cost. There is no incremental fixed cost as I specified in the question. So only thing that we have beta is 6 rupees beta here. 6 rupees. Case 2 beta. No spare capacity. No spare capacity. Okay. No spare capacity beta. Variable cost of manufacturing is 6 rupees. External selling price beta is 10 rupees. External selling price is 10 rupees. So यहाँ पे beta I'll write minimum transfer price. Because there is no spare capacity beta, you will obviously write your variable cost plus contribution foregone. Contribution foregone is such beta. So this would be 6 plus, this is variable cost of manufacturing beta, 6 plus 4, 10 rupees. You will obviously not want to transfer beta for anything less than 10 rupees because that is your opportunity cost now. That is your opportunity cost. Understood, sir. What if I tell you, sun lo beta. What if I tell you beta that there is no spare capacity? There is no spare capacity beta. Your variable cost of manufacturing is 6. Variable selling expenses are 1 rupee for external sales beta. And external selling price is 10 rupee. Now please do not forget beta, contribution per unit guys of external sales. Contribution per unit of external sales beta is only 3 rupees. And variable cost per unit beta for internal transfers. You will not incur beta variable selling expenses. For internal transfers as such beta, it is only 6 rupees. No selling expenses. So यहाँ पे if you want minimum transfer price beta, यहाँ पे if you want minimum transfer price, you will have to adjust that. You will add only 6 plus 3, 9 rupees. You will not write 10 rupees anymore because I am not going to incur variable selling expenses on internal transfers. Sir, we did all of these cases, sir, already in make or buy decision. I know better. Instead of using the word minimum transfer price there, I use the word relevant cost of manufacturing. Instead of using the word minimum transfer price better there, I've used the word relevant cost of manufacturing. Nothing else, guys. Nothing else. Say, guys, case 4. Spare capacity is available. Spare capacity is available. Quantity required by division B. सुन लेना बेटा. Quantity required बेटा by division B is say बेटा 2500 units. Variable cost of manufacturing is 6 rupees. If units are not internally transferred, if units are not transferred, if units are not transferred, the space beta can be rented out, for rupees 7,500. 7,500. Now this loss of rent beta will become opportunity cost. The loss of rent beta will become opportunity cost. Opportunity cost as such, guys. So here when you write beta minimum transfer price, so you will not only want to recover 6 rupees, but then you will also want to recover the 7,500 beta from 2,500 units. Please understand, guys, that if you were to manufacture additional units and transfer internally, guys, you will not be able to realize that rental income. If you are not manufacturing as such, guys, additional units, and you are not transferring to the other division, you can use this space to lease it out to others, and that will bring us a revenue of 7,500, a profit of 7,500. So that profit of 7,500 that I'm foregoing now is being considered as opportunity cost. Opportunity cost need not be contribution foregone on existing products. No, it can come in any form. Understood, sir? Please write these examples, but छोटे मोटे examples है. We will obviously be doing, guys, a lot of questions later. Understood, sir? Yes, sir. Please copy, guys. All of you better copy this. I hope you're all writing this. Case 3, beta. I hope you're all done with the third case as well, guys. Yes, beta. I think I gave you a lot of time to copy all of this. ठीक है? हाँ sir. We will now do question number 1, guys. We did second and third question already, beta, in the previous class. We will now be solving question number 1, beta. Question number 1. Division A. This is given as an illustration, guys, or as an example in ICI study material, not as a question. Division A produces goods at a cost of 10 rupees per unit and transfers the goods to Division B, which has additional cost of 5 rupees per unit. Division B sells externally at 16 rupees per unit. The company has a policy of setting transfer prices at cost plus 20%. Calculate the profit of each division and the overall profit of the company made. Write a brief analysis of the results. Write a brief analysis of the results. है क्या बेटा क्वेश्चन में? सर कुछ नहीं है सर, पढ़ने दो सर फिर. Yes, but I forgot. I'm just giving you 10 seconds, beta. Very small question. Very small question, beta. Just go through it, beta, once. Yes, beta. तो यहाँ पे guys, you know what is the cost of division A, guys, and what is the problem solving book, guys. Please do not forget problem solving book. तो यहाँ पे बेटा, you know what is the cost, beta, that division A is incurring as such, guys. Cost incurred by division A. Cost incurred by division A, beta, is 10 rupees per unit. 10 rupees per unit. Your transfer price, beta, transfer price for transfers from A to B, guys, is cost plus 20% markup. We have learned about this, beta. This is under cost based pricing methods. The last one was cost plus markup. So here, guys, this would be 10 rupees plus 20% markup. 20% markup as such, beta, 12 rupees. If you look at the profitability statement, guys, if you look at the profitability statement, we already prepared profitability statements, guys, of divisions. This is not the first time again. There is division A, there is division B, and then there is the overall company. There is division A, guys, there is division B, and then beta there is the overall company, guys. As far as the revenue is concerned, beta, the transfer price, beta, from division A to division B is 12 rupees. The external sales as such, guys, being made by division B is 15 rupees. Is 15 rupees. Overall company, beta, revenue is only 16 rupees, guys. 16 rupees. As far as cost is concerned, beta, the transfer, beta, from one division to the other division as such, beta, is costing them 12 rupees. The other cost, beta, that is incurred by division A is 10, division B, beta, is 5. Overall cost as such, beta, is 15 rupees. Overall cost, beta, is 15. If you look at the profit, division A, beta, it makes 2 rupees as such, guys. Division B makes a loss of 1 rupee. Overall company makes 1 rupee profit. I hope you're all listening, guys. Division A, beta, makes a profit of 2 rupees. Division B, beta, is actually incurring a loss of 1 rupee. Overall company is making a profit of 1 rupee. They were asking us to write a brief analysis of all of this. Brief analysis. Brief. Short analysis, beta, here. So when they say short analysis, guys, please understand what is the overall margin on the product, guys. Overall margin on the product. As far as the entire company is concerned, guys, overall margin on the product, beta, as a percentage of cost. As a percentage of cost. The company as a whole, beta, is making only 1 rupee. That too on a cost of 15 rupees. The company as a whole, beta, is making 1 rupee. That too, beta, on a cost of 15 rupees, beta. So that is 6.67%. 6.67%, beta, is the overall margin, guys, on the product as a percentage of cost. As a percentage of cost, beta, that is 1 divided by 15, guys, 6.67%. Yes, sir. The margin of division A, beta, the margin of division A, beta, is 20%. as division A beta is charging a very high margin, division B guys will always, division B is incurring a loss, division B beta is incurring a loss. This would be your analysis as such guys. इसके वजह से बेटा behavioral consequences what will happen बेटा, division B beta will be demotivated as such guys, he will obviously beta will not be motivated as such guys to sell more, yes or no? So is this transfer pricing of 20% justified as such guys? Should we look at guys procuring it from the external market as such beta, or should we source a component from outside as such guys? Is there any portion that is controllable? Can we reduce cost? All of those beta behavioral consequences here. Behavioral consequences beta. Obviously guys division B beta will not be motivated to sell. Plus do not forget guys, if division B is not selling, isn't the company as a whole losing 1 rupee guys? If division B is not selling, company as a whole beta will lose 1 rupee. Company will lose 1 rupee. Obviously no beta, company will lose 1 rupee. So what are we supposed to do beta? Is transfer price justified? Can cost be reduced? Should we procure from outside market? Should we procure from external market? All of these questions will arise beta. समझ में आ रहा है? हाँ सर. Please write guys. Copy कर लो बेटा. Very simple question guys. It is just an example guys that has been given. Just an example beta that was given. All of you better do this. खत्म करो बेटा ये. Yes बेटा. लिखो. All of you guys write. Yes guys. Here बेटा. I hope you're all writing this. Here beta behavioral consequences. Chalo guys, I hope you're all done with this. I gave you a lot of time and such, but now question number 5. We're done with the first 3 questions, guys. We're now doing question number 5. Again, an ICI study, ICI SM, जहाँ पे भी mentioned है ना बेटा, those are ICI study material questions. In this chapter, there are a lot of questions that I've included, guys, that are not a part of ICI study material or the case study digest or the revision test paper or the mock test paper or the previous question papers. So you can do them now better all at once, but before the examination, you can stick to ICI study material questions as such, guys, or wherever I write ICI, RTP, MTP, you can refer those questions. Division A transfers goods to Division B. Division A incurs a marginal cost of 10 rupees per unit. Division B incurs a marginal cost of 5 rupees per unit. To process it further, Division B sells finished product externally at 20 rupees per unit. So we know what is the marginal cost of the first division, but at 10 rupees. We know what is the additional cost that Division B will incur, 5 rupees. We know how much better Division B beta will fetch by selling this product in the external market, 20 rupees. To promote goal congruence, the minute you see this wording as such, guys, you should recollect acha minimum transfer price, maximum transfer price, range of transfer price. Minimum transfer price beta is whatever is your additional outlay per unit as such, guys, plus opportunity cost per unit. Maximum outlay as such beta will be lower of net marginal revenue, guys, net marginal revenue and supplier price. You have to recollect this immediately beta when they say to promote goal congruence. समझ में आ रहा है सर? Yes. What should be the minimum transfer price that A should charge? Assume that there is no external market for this intermediate product. Because there is no external market, there is no opportunity cost as such, but a minimum transfer price should be equal to the amount of marginal cost per unit, guys. Because 10 rupees is the only incremental cost beta that division A beta would incur, and hence beta that 10 rupees would become relevant for decision making. If division B beta can buy the intermediate part externally for rupees 14 per unit or 18 per unit, what should be the maximum price that division A beta can charge? What is the maximum price that division A can charge as such, guys? Please understand beta, if this answer to the second beta such beta is maximum transfer price, it will be lower of net marginal revenue beta and the supplier price. Assume that intermediate goods of division A beta can be sold externally at 12 rupees per unit. How does this opportunity cost affect the transfer price range when division B beta can procure that part externally at 14 rupees per unit? A very basic question, a very simple question, guys. I would wait for a minute so that you read the question and then we'll do it collectively. Very simple question बेटा, साथ में करते हैं. पढ़ो question, पढ़ो एक बार पूरा question पढ़ो बेटा. Yes, guys. I hope you all read the question. So, guys, first we will write the concept beta. We all know beta that we have seen the word goal congruence here. Yes. Yes, sir. Goal congruence bola beta. Whenever he uses the word goal congruence or he says beta for the purpose of decision making, remember beta these parts. The minimum transfer price. The minimum transfer price as such, guys, should be whatever is the additional outlay per unit, additional outlay per unit, or that is your incremental cost per unit beta, plus opportunity cost per unit if any, opportunity cost beta if any. Your maximum transfer price beta, maximum transfer price would be lower of net marginal revenue, net marginal revenue, net marginal revenue, guys, and external buying price, that is supplier price, external buy-in price, supplier price. The minute you see goal congruence as such beta, in any question you're supposed to write this. No if, no but, ये लिखना ही है beta. We will have to write this clearly. Understood, sir? Once you write this minimum transfer price and maximum transfer price as such, guys, what next is understanding. यहाँ पे बेटा given case में क्या क्या है. The marginal cost as such beta of division A, guys, of division A is 10 rupees. Division A beta is your selling division, is your selling division. ठीक है? Yes, sir. The incremental cost incurred by division B, incremental cost incurred by division B, guys, which is your purchasing division. Division B beta is purchasing component from division A. Apart from paying whatever is the transfer price to division A beta, they will have to incur 5 rupees, and the selling price beta of division B, selling price is 20 rupees. I can say beta that the net marginal revenue to division B is, net marginal revenue to division B is 15 rupees. This is the information that is going to remain constant for the entire question. Your net marginal revenue is not going to change as such, guys. External supplier price is changing better. There is external demand coming into picture. So your marginal cost per unit is not going to change. Net marginal revenue is not going to change. This is just the given information, guys. Based on this, we are going to attempt all of those bits. Based on this, we are going to attempt all of those bits. I know you were all doing it with me, guys, but still, I will just wait in case someone is not done better with this. ये given information है बेटा, copy कर लो. This is your given information, guys. All of you बेटा can copy this. All of you guys can copy this बेटा. I hope you're all done with it. बेटा कहाँ 1 मिनट बोल के 10 घंटे दे दिया तुम लोग को मैं. You must have finished off the question also as such, guys. You must have finished it off. First bit, guys. There is no external demand. Read the question properly, guys. There is no external market. There is no external market, which means, guys, there is no opportunity cost. Which also means, beta, that there is no opportunity cost. So you can directly write, beta, your minimum transfer price. Your minimum transfer price as such, beta, would be the incremental cost per unit incurred. Incremental cost per unit. That is your marginal cost per unit, guys. Marginal cost per unit 10 rupees. This itself, beta, would be your incremental. This itself, beta, would be the amount of marginal cost. This itself would be the amount of marginal cost. Understood, sir? They're also asking us to compute maximum transfer price, guys. Iske niche there are two cases. Under maximum transfer price, beta, there are two cases. Case 1, if the external buying price, if the external supplier price is 14 rupees. 14 rupees. Do not forget, beta, maximum transfer price, guys. Maximum transfer price is lower of net marginal revenue, guys, and external supplier price. Net marginal revenue, beta, and external supplier price. Yes or no? Yes, sir. So that, beta, would be lower of 14 and 15. Why will he want to pay you, guys? Lower of 14 and 15, guys, that is 14 rupees. Why will he want to pay you 15 rupees as such, guys, when he knows that he can buy from the external market at 14 rupees? Even if he's paying a maximum of 14 rupees as such, guys, he will be making a profit of only 1 rupee. He would be making a profit of only 1 rupee even if he pays 14 rupees. At 15 rupees, he will not make any profit, guys. At 14 rupees, he will make a profit of 1 rupee. So यहाँ पे बेटा, if you want range of transfer price, it will be 10 to 14. 10 to 14. 10 is minimum. 14 is maximum. 14 is maximum. Please understand, guys. Because he can procure from the external market at 14 rupees as such, but the other division will not pay you a penny more than 14 rupees as such, guys. इसके नीचे बेटा case 2, if the external supplier price is 18 rupees. If the external supplier price as such, beta, is 18 rupees. Now, beta, your maximum transfer price, beta, your maximum transfer price, guys, will not be lower of 14 and 15. It will now be lower of 18 and 15. ठीक है, he knows that he can procure from the external market at 18 rupees. But then why will he want to buy at 18 rupees and incur losses? But then why will he buy at 18 rupees and incur losses? Instead, beta, the maximum that he will pay, beta, is 15 rupees. Remember, beta, the division B's profit is 0. Division B's profit is 0, beta, at 15 rupees. At 15 rupees. Let us not forget this, beta. So यहाँ पे if you want range of negotiations as such, beta, range of negotiations, let them, beta, argue between 10 to 15. 10 is minimum, 15 is maximum. 10 is minimum, 15 is maximum. समझ में आ रहा है? हाँ sir. These are the answers to the first two bits, guys. Third bit, beta, it will be 12 plus. I'll write third bit also, guys. There is external demand, beta. External demand for product of division A. For product of division A, guys. Because there is external demand, beta, for product of division A, guys, there will be opportunity cost. There will be opportunity cost. How much is your opportunity cost as such, beta? Division A ka, beta, selling price is 12 rupees. Cost is 10 rupees. Marginal cost. So their contribution per unit is 2 rupees. So if you now talk about minimum transfer price, beta, they will undoubtedly charge variable cost of 10 rupees. But also levy contribution foregone of 2 rupees. And they'll say, boss, minimum transfer price is 12. Division A, beta, can procure, or division A, beta, can realize 12 rupees from the external market. Why will they want to give you at anything lesser than 12 rupees? When division A, beta, can procure or can realize 12 rupees in the external market, why will they want to give you at something lesser than 12 rupees? Is that possible? Just not possible, guys. Just not possible. Maximum transfer price, beta, will be again lower of 14 and 15. Lower of 14 and 15, guys. So that, beta, would be 14. If you talk about range of transfer price, beta, range of transfer price, it will now be 12 to 14, guys. Usually, beta, closer to 12. Usually, beta, closer to 12. Because the receiving division, beta, is still, the selling division, beta, would still realize entire profits that would have otherwise realized. That they would have otherwise realized, beta. I hope you're all clear about this, guys. I hope you're all clear about this. Please make a note of it, guys, or if you're already done with it, beta, please read question number 4. Take your time, guys. There is no hurry. Understand these are all the basics. These are all basics, guys. Hope you're all done with case 2, guys. Let us move to case 3 now. नहीं हुआ तो ये pause कर लेना बेटा. Just in case you're not done with it, beta, you can pause the video. Yes, guys. Chalo beta. I think I give you a lot of time, guys, to go through the question. That was question number 5 beta. We could have answered it beta in one line also, guys. Matlab one liners. But ठीक है. अच्छा, sorry. Question number 4 beta. Let us finish question number 4, guys, and then come to question number 6. All right, sir. G is the transferring division. R is the receiving division in a company. R has a demand for 20% of G's production capacity, which has to be first met as per the company's policy. Company's policy beta negotiated transfer price nahi hai. Matlab you are not giving them autonomy to decide whether they want to sell it internally or whether they want to sell it in the external market, guys. As per the company's policy, internal transfers should be first met. Internal priority should be given to internal transfers. State with reason which division G or R enjoys more advantage in each of the following independent situations, assuming no inventory buildup. Assuming no inventory buildup as such, guys, you will have to decide as to which of them better enjoys a more advantageous position. Please understand the question properly, guys. G transfers to R at transfer price equal to full cost plus markup. They're transferring at full cost beta, no markup. Sorry, I read it as plus markup. Full cost beta, no markup. Right now the external demand is 40%. That means we have enough spare capacity available as such, guys. We have enough spare capacity available. And because you are accepting a demand of 20% as such, guys, you will be operating at 60%. Right now, but the production capacity is 40% as such, guys. If you accept that order, you will be operating at 60%. Understood, sir? Who's at an advantageous position, guys? You will have to think about it, guys. Before I tell the answer, you can hit the pause button, guys, right? Who's having an advantageous position, then I will explain. You can obviously hit the pause button as such, guys, and write who's having a more advantageous position as such, but there. Do not write reasons. Think about the reason. I will make you write all of those notes as such, guys. Okay, beta. I'm assuming that you've already hit the pause button and you've tried to evaluate it. So in the first case, guys, as you have thought, as you have answered it correctly as such, guys, it is division G beta that has a more advantageous position. The incremental cost of moving from 40% to 60% as such beta will only be marginal cost, but then they're still charging full cost as such beta. That means he's recovering as such, guys, fixed cost also beta. He's recovering fixed cost also beta from these transfers. So obviously beta, G is having a more advantageous position here. G has a more advantageous position. Right now, but the external demand is 60%. If they accept the order, they will be operating at 80% and they're transferring at market price. Same explanation as above, guys. Not just recovery of variable cost, incremental cost, you're recovering profit from internal transfers. So G is undoubtedly in an advantageous position. You ask me about minimum transfer price. Case 1, minimum transfer price is marginal cost. Case 2, minimum transfer price is marginal cost. Anything more than minimum transfer price, beta, G is in an advantageous position. G is in an advantageous position. Understood, sir? Third one, beta, marginal cost 80% to 100%. He's recovering exactly his incremental cost as such beta here. Again, we have spare capacity of 20% as such beta and he's recovering as such beta exactly equal to marginal cost. So because he's recovering only marginal cost as such beta here, you will say division R beta undoubtedly has an advantageous position. Division R beta undoubtedly has an advantageous position, guys. Market price beta 90%. Right now they are operating at 90%. If they accept the order beta, they will have to forego 10% of external sales. If they accept the order, they will have to forego 10% of external sales and they have spare capacity of 10% available. So to the extent of 10% external sales foregone as such, guys, it should be market price, that is variable cost plus contribution foregone. But for the remaining 10% beta, incremental cost is only marginal cost. But यहाँ पे beta, for the entire 20% they are charging market price. For the entire 20% they are charging market price. Isn't that an advantageous position to G again? Yes, sir, it is advantageous position to G. I hope you're very clear about it, guys. We will now write the answers, guys. We will now write the answers. Question number 4. I hope you've got the right answers to all the 4 bits, guys. All the 4 bits. Question number 4, guys. Option. पहले ये लिखो, guys. Your selling division, beta. Selling division. Or the transferring division is such, beta, is division G. Transferring division is division G. Purchasing division better or the receiving division? Purchasing division, guys, or the receiving division? Yes, division R. Division R. R has a requirement equal to 20% of G's capacity. R has a requirement beta equal to 20% of G's capacity. G's capacity. I'm just writing the given information, guys. As per company's policy, preference should be given to internal transfers. Preference should be given to internal transfers. We should always give preference better to internal transfers as per the policy of the company, guys. As per the policy of the company. Understood, sir. First bit, guys. Who has an advantageous position, guys? G is the answer. Reason क्या है बेटा? G has an advantageous position as such बेटा. Reason is the existing capacity utilization. सब लोग साथ में लिखो बेटा. Existing capacity utilization. और external demand बेटा is only 40% of capacity. External demand is for only 40% of capacity. Is for only 40% of capacity. So there is a spare capacity of 60%. 60%. The incremental cost, that is marginal cost beta, will be the minimum transfer price. Marginal cost will be the minimum transfer price. However, division G beta is recovering full cost. Division G beta is recovering full cost. Full cost as such beta, including fixed cost portion. So obviously beta in an advantageous position. Including fixed cost. That is why they are in an advantageous position. I'll zoom in, guys. Wait for a minute. I hope you all understood this, guys. Write all of that information, then I will give the answers to the other bits, guys. Yes, beta. I hope you're all done with the first bit, guys. Let us now move to the second bit. You already know the answers to everything, guys. We are just writing down the answers, okay? Please do it with me, guys. Second bit, beta. Again, guys, who's in an advantageous position, you can recollect, beta. Reason, guys. Again, beta, external demand is only for 60% capacity. External demand is for only 60% capacity. 60% capacity, guys. And then so there's a spare capacity of 40%. There is a spare capacity of 40%. Though the relevant cost, beta, though the relevant cost is only marginal cost. Though the relevant cost, beta, is only marginal cost. Is only marginal cost. Division G is charging market price for internal transfers. Division G, beta, is charging market price. Market price for internal transfers. I hope you're all clear about this, beta. Division G, guys, is charging market price, beta, for internal transfers. Understood, sir? This is the answer, sir, to second bit, sir. Third bit. Third bit, guys. Division R, guys. Why division R? The external demand, beta, is for 80% capacity. External demand is for 80% capacity. Internal transfers are out of spare capacity. Internal transfers are out of spare capacity. Out of spare capacity. Incremental cost is marginal cost. As transfers are made at marginal cost only. As transfers are made at marginal cost. Marginal cost. There is no profit accruing to division G. There is no profit accruing to division G. Division R, beta, is procuring at a very low price. Division R is procuring at a very low price. Division G, guys, here, and division R. I hope you're all done with this, guys. नहीं हुआ तो pause करके लिख लो बेटा second bit. If you're not done with the second bit, guys, you can always pause and copy, guys. You can always pause and copy. Yes, beta. Third bit, guys, here. I hope you're all doing it. Yes, sir. Fourth bit, beta. Market price. Division G, guys. Reason देखो बेटा. External demand, guys. External demand is for 90% capacity. 90% capacity. So spare capacity is 10%. Spare capacity, beta, is 10%. Internal transfers, guys. Internal transfers are 10% out of spare capacity. 10% out of spare capacity and 10% out of 10% beta by reducing external demand. By reducing external demand. Okay. The minimum transfer price, guys. The minimum transfer price for 10%. The minimum transfer price beta for spare for capacity transfers out of spare capacity beta. For transfers out of spare capacity is marginal cost. Marginal cost. By reducing external demand, by reducing external sales. By reducing external sales, it should be market price. But division G, guys, is charging market price for the entire 20%. Division G beta is charging 20% for the entire market price. For the entire is charging 20% कहते क्या बोल रहा हूँ यार is charging market price for the entire 20%. For the entire 20%. ठीक है? Yes, sir. I hope you're all done with the third one, guys. नहीं हुआ तो pause करके copy कर लो. I'm zooming in as such, guys. And if you are done with that, Asaj beta, please copy the fourth one. All of you better copy the fourth one. Yes, guys. I hope you've all done recording this better. Abhi, guys, I started recording as such, guys, without hitting the resume button. I had to pause the video, and then I realized कि मैं बोलते जा रहा हूँ and recording ही नहीं हो रहा है. ऐसे होता है बेटा बहुत बार हमारे साथ. See, I've been talking बेटा from the last so many minutes. Question 6 explain कर रहा था बेटा मैं. Question number 6 बेटा now. We are done with the first 5 questions. A company is organized on decentralized lines, guys. This is why beta there is decentralization. This is why beta we have decentralization. Yes or no? Yes, sir. With each manufacturing division beta operating as a separate profit center. Each manufacturing division, guys, operating as a separate profit center. Each division manager has full authority, guys, to decide on sale of the division's output to outsiders and to other divisions. Okay. Division C has always purchased its requirement of a component from Division A. But when informed that Division A beta was increasing its selling price to 150, the manager of Division C decided to look at outside suppliers. So Division A beta wants to increase the price to 150. So Division C is now looking at an option of procuring it from the outside market. Division C can buy the component from an outside supplier for rupees 135. We can buy the component beta at 135 rupees. Division A refuses to lower the price in view of its need to maintain the return on investment. The annual purchase of the component is 1000 units. Variable cost is only 120 rupees. Fixed cost is 20 rupees. Please do not forget, beta, there is no way that you arrive at net marginal revenue, guys. We do not know what is the external selling price of Division C. We do not know what is the incremental cost that they are incurring. So we will take a decision, guys, only on the basis of external supplier price and on the basis of our marginal cost, our opportunity cost. ठीक है? Yes, sir. Let us all read the question, guys. Let us all read the question, बेटा. सब लोग क्वेश्चन पढ़ो गाइस अभी. ठीक से पढ़ो बेटा सब लोग क्वेश्चन. Yes, guys, please go through the question. Yes, guys, I hope you're all done with this. Now, beta, here, guys, question number 6. What do you have to understand better about the question? Question is very, very simple, guys. Question is not at all complicated. I gave you time to read the question on your own as such, guys. पहले तो बेटा I will write the given details. Division A beta is your selling division, or you can say this is your transferring division. Transferring division. Yes or no? Yes or. Division B beta is the purchasing division, or guys it is the receiving division. Receiving division. Division A beta is selling or transferring division as such, guys, and division B beta is purchasing or receiving division. Purchasing beta or receiving division. Yes, guys. तो यहाँ पे बेटा what you'll have to understand is first division A beta, the variable cost per unit is 120. Fixed cost per unit, guys, is 20. Not relevant for decision making. Not an incremental cost, not relevant. Not an incremental cost बेटा, this will not be relevant. इसको साइड में रखो, इसको साइड में रखो बेटा, ठीक है? Yes sir. Division B, guys, external supplier price for them is 135. 135. Division A beta wants to transfer it. It wants to transfer beta at 150 rupees. ठीक है बेटा, you just because they want to transfer at 150 rupees, that does not mean the other division beta is going to buy at 50 rupees, 150 rupees, right? They want to maintain their ROI as such, guys. That does not mean beta that these people lose out on their lose out on their return on investment or lose out on their profitability. This is the given information, guys. First bit is asking us, will the company as a whole benefit, guys, if division C bought the component at 135 rupees from an outside supplier? This is merely better decision making. This is merely decision making, guys. सुन लो बेटा first bit का answer. You will also know the answer, guys. You can always hit the pause button, answer all the 3 bits, guys, and then we can do this collectively. Then we can do it collectively, beta. So you can always hit that pause button as such, guys, and finish off the first 3 bits. Finish off the first 3 bits, guys. समझ में आ गया सर? आगे बोलो. तो guys, in the first bit, beta, here, in the first bit, guys, here, the minimum transfer price, guys, minimum transfer price, please understand beta that there is no outside market as such, guys. There is no opportunity cost, correct? कुछ भी नहीं दिया बेटा. We will have to assume that there is no opportunity cost. Variable cost of division A beta, that is 120 rupees, guys. Assume no opportunity cost. I did not see that as such, guys. If there's anything that given beta that says there's no opportunity cost, there's no opportunity cost. Okay. Maximum transfer price beta. Maximum transfer price beta would be lower of. This is from the viewpoint of the other division. Lower of marginal net revenue. Lower of marginal net revenue, guys. Marginal net revenue, guys. An external buying price. An external supplier price. I'll directly write beta 135 as marginal net revenue is not known. Marginal net revenue beta is not given. Marginal net revenue as such beta is not given. So let us just forget it as such beta. We'll directly write external supplier price is 135. So guys, if division B procures from external market, company as a whole beta will lose 15 rupees per unit. Company as a whole beta will lose 15 rupees per unit. How 15 rupees per unit, sir? We are procuring, forget this beta, we are procuring a component beta that can be manufactured. We are procuring a component that can be manufactured at 120 rupees. We are procuring a component beta at 135 rupees, which can be manufactured at 120 rupees only by us. Which can be manufactured as such, but at 120 rupees only. At 120 rupees only. ठीक है guys, real life में बेटा computing exact variable cost per unit and all of that is impossible guys, because in the very first part of this syllabus guys, strategic cost management, they have taught us beta one thing, that cost is not merely a function of output. This is what beta we have learned under the very first chapter beta, strategic cost management, under cost driver analysis. We have learned about executional cost drivers, we have learned about structural cost drivers, we have learned about, obviously beta there are drivers based on cost volume as such beta, volume bhi hai beta. So we have learned better about activity based costing. We know that cost is not driven better by volume. What if better due to producing these 1,000 units as such guys, I need higher maintenance of my machine guys. So that maintenance of the machine is increasing. It is very very important better that we arrive at accurate costing for the purpose of all of this. It's not as simple as this beta ki theek hai, this is variable cost, this is fixed cost, lo compute karo. It doesn't work like this beta practically. Understood sir? This is the answer to question. Bit 1 guys, and then we will do the other 2 bits guys. And then beta we will do the other 2 bits. Please copy this guys. Hope you're all done with this beta. बहुत ज़्यादा time दिया क्या? Second bit guys. All of you better now perform the second bit. If A did not procure the material, did not produce the material for C beta, it could use the facilities for the other activities, resulting in a cash operating savings of 18,000. Should C then purchase from outside sources? Now this is good beta. So basically guys, if A transfers to C beta, it will lose out it will result in an opportunity cost of 18,000. See guys, you will realize 18,000 only if you do not transfer beta, so that 18,000 beta will now be considered as opportunity cost. If A transfers to C beta, it will result in an opportunity cost of 18,000. Opportunity cost beta of 18,000. The minimum transfer price beta would be variable cost plus contribution foregone per unit. 120 plus 18,000 rupees divided by 1000 units beta. So that is 120 is your variable cost, 1838. The maximum transfer price as such guys will still be beta your external buying price only, because there is no other details given beta. And this is 135. Now what should you do beta? It is very clear cut as such beta. Therefore division C beta should procure from outside market. Division C beta should procure from outside market. You should not manufacture the component on its own, because if it is manufacturing the component on its own as such guys, it will lose out 3 rupees per unit. Internal transfers better. See guys, the amount that you will save guys by not transferring is 18,000, and the incremental cost that you're going to, however you want to present it guys, you can present like this also. If I do not transfer, I will save 18,000 and the other division will incur 15,000 more. Overall company is still saving 3,000. Overall company is still saving 3,000. Anyway beta, however you want to answer beta, you can write in that manner. There is no compulsion that you will have to attempt only in a particular way. Got it sir? Copy sir. Then all of you beta copy if you've understood it. I hope you're all done with this guys. The last bit guys, third bit now. Third bit guys, suppose there is no alternative use of ACE facility guys, and the market price per unit of the component drops. No alternative use beta means that there is no alternative use. Simply means beta that there is no opportunity cost. Correct? Correct sir. So if there is no alternative use beta, if there is no opportunity cost, what am I supposed to do? What are you supposed to do beta? Here it says guys, your minimum transfer price will still be beta your variable cost per unit. Variable cost per unit beta, which is 120 rupees. Whereas the maximum transfer price beta, that is your external supplier price. This is from the viewpoint of the entire organization beta. You can always compare external supplier price. You can always compare guys variable cost per unit, that is relevant cost of manufacturing beta, with the external price also, 115. Therefore beta, division C should buy from outside. Should buy from outside beta. Our own variable cost of manufacturing is more guys. External supplier price is less. Simple question guys. Question number 7 is a copy of this. I'm going to wait for 30 seconds and then we'll start question number 7 beta. We will start question number 7 guys after this. I hope you're all done with this, guys. Let us now proceed to question number 7, beta. Question number 7. A company is organized into two divisions, guys. Division X produces a component which is used by Division Y in making of a final product. The final product is sold for 540 rupees. Division X has a capacity to produce 2500 units and Division Y can purchase the entire production. The variable cost of Division X in manufacturing each component is 256.5. Division X has informed that due to installation of a new machine, its depreciation cost had gone up and hence wanted to increase the price of the component to be supplied to Division Y by that to 297. However, Division Y can buy the component from the outside market at 270 rupees only. The variable cost of Division Y in manufacturing the final component by using the component bit as 202.5 excluding component cost. Prepare a statement, guys, indicating the position of each division and the company as a whole, taking of the following situations separately. If there is no alternative use for the production facility, will the company benefit? If Division Y buys from outside suppliers at 270 per component, if internal facilities of X are not otherwise idle and the alternative use of the facilities will bring in an annual cash saving of 50,625 rupees, should Division Y procure the component from the outside market? If there is no alternative use for the production facilities of Division X and the selling price for the component in the outside market drops by 20.25, should Division Y purchase from the outside supplier? What transfer price would be fixed for the component in each of the above circumstances? It's an exact copy of the question that we did better now. I would want you to go through the question, guys. Read the question properly better. Take a little time, guys. Take 2 minutes, understand the entire question. And then we'll present it collectively better. We would be presenting it collectively, guys. Aram se padho, guys. Try to understand the question first. Yes, guys. Did you go through the question? Yes, sir, we did. So let us answer the question, guys. Let us answer the question better. Question number 7, guys. Here, better again, division X is your selling or transferring division. Selling or transferring division. Right, sir? right beta. Division Y is your purchasing or the receiving division, right sir? Right. Capacity of division X beta is 2500 units. Requirement of division Y beta is entire 2500 units. Entire 2500 units. The variable cost per unit beta for division X is 256.5. The variable cost per unit for division Y guys, excluding component, they will have to incur 202.5. मैं नहीं बोल रहा बेटा, क्वेश्चन बोल रहा है. And their external price as such beta, the selling price as such beta for division Y is, the selling price beta for division Y is 540 rupees. 540 guys. So all of this beta is basically giving us 337.5 rupees. 337.5 beta is your net marginal revenue guys. I should have used that word. The net marginal revenue beta. We will be using this beta. This was not given in the previous question, but at least here beta we have net marginal revenue as 337.5. So we got variable cost per unit of division X, we got variable cost per unit for division Y guys, we got selling price per unit. We have also have the external supplier price guys is 270. External supplier price is 270. These are just the given details guys. Look at the first bit guys. There is no opportunity cost. There is no opportunity cost beta. So the minimum transfer price guys from the viewpoint of division X, the minimum transfer price beta will be the variable cost of manufacturing, which is 256.5. Maximum transfer price, minimum transfer price beta is 256.5. That is variable cost of manufacturing guys. Whereas your maximum transfer price beta, maximum transfer price would be lower of net marginal revenue and supplier price. Obviously beta it is lower of 337.5 and 270, that is 270. Understand it like this guys. When the company can manufacture, forget divisional beta, when the company can manufacture beta 256.5, it should not procure from external market at 270. It should not procure beta from external market at 270. Are we getting the point? Yes sir. Isn't it the same question guys being repeated again and again? Yes sir. It should not procure from the external market at 270. I'll write beta range of transfer price also beta here. What transfer price would be fixed, but I'll say range of transfer price 256.5 beta to 270. 256.5 beta to 270, this would be the range of transfer price as such guys. Range of transfer price for proper decision making as such guys. If you want, if there's some other output decision guys of the other division still being taken, if there's some output decision guys that the other decision still has to take as such guys, then beta you can say that it should be variable cost per unit and get done with it. Just 256.5 guys, nothing more than that. Understood sir? ठीक है बेटा. I hope you're all clear about this guys and there is no doubt. Copy karo beta ye. Copy the first bit guys and then we'll do the second one. Copy the first bit guys, all of you guys. If you're already done with it beta, please proceed to the next bit. अगर ये हो चुका है तो बेटा you can proceed to the next bit. Yes beta, please do make a note of it guys. Chalo guys, I hope you're all done with this. I gave you a lot of time. Look at the second bit guys here. It says if internal facilities of X beta are not otherwise idle and the alternative use of the facilities will bring in an annual cash saving guys of 50,625 to division X, should division Y procure the component from outside market? So guys, there is an alternative use of division X facilities. There is an alternative use of division X's facilities beta, facilities. Alternative use will result in a saving of kitna beta 50,625 rupees, 50,625. Now beta, if division X transfers internally, if division X beta transfers internally, 50,625 beta should be considered as opportunity cost. Should be considered as opportunity cost beta. समझ में आ गया सर? What will that be guys now? So your minimum transfer price beta, minimum transfer price guys here would be variable cost per unit plus opportunity cost per unit. That is additional outlay per unit beta plus opportunity cost per unit if you want to use the exact wording that ICI uses. So here beta, this is 256.5 plus 50,625 divided by 2,500 units. Isn't that 256.5? Perfect. 50,625 divided by 50,625 divided by 2,500. So 256.5 beta plus 20.25 is 276.75. 276.75. The maximum transfer price beta, the maximum transfer price as already concluded beta in the previous bit is 270. ऐसे समझो बेटा that the relevant cost of manufacturing, you have to understand like this beta, your relevant cost of manufacturing as such beta is 276.75, whereas your external supplier price beta is only 270. What do you think beta you will do? What do you think beta you will do? Division Y beta should procure from external market. Division Y should procure from external market. I already gave you this conclusion guys, that if your minimum transfer price is more than maximum transfer price, there will not be any internal transfers at all. If your minimum transfer price beta is greater than external transfer price, there will not be any internal transfers at all as such guys. So यहाँ पे you will write beta division Y should procure from external market. Should procure beta from external market. That is the answer to second bit. I hope you've all done it guys. I'll just wait for a minute. I'll wait for a minute guys. I'm pretty sure that you've all done it guys. यहाँ पे guys fourth bit का answer नहीं आएगा because there are no internal transfers only. Because there are no internal transfers guys, fourth bit will not come. ठीक है? Yes sir. Copy करो बेटा ये. Here guys, I hope you're all done with this. We're all done with this, guys. Third bit, guys, now. If there is no alternative use for the production facilities of product X, guys. Third bit beta bolta hai no alternative use. No alternative use, which means there is no opportunity cost. Same bit se beta again and again, again and again. But guys, they're all very, very important, guys. I cannot, you guys know better that you'll have to score 10 on 10 in these bits. Minimum transfer price beta is equal to variable cost per unit, and our variable cost per unit beta is 270. 256.5. Maximum transfer price beta will be your net marginal revenue beta is 337.5. Supplier price, though the supplier price beta was 270, it is now dropping by 20.25, so it is 249.75. so this beta is 249.75. supplier price beta is dropping by 20.25, guys, so 249.75. maximum transfer price 249.75. what should you do better? Division Y, guys, should procure from external supplier, should procure from outside supplier, outside supplier. Understood, sir. ऐसे सोचो बेटा. Relevant cost of manufacturing is 256.5. Relevant cost of manufacturing is 256.5, whereas the external supplier price beta is 249.75. so yes, there's a difference of 6.75 जो यहाँ पे भी था. ठीक है guys, last beta ये खत्म करो. I hope you're all done with this beta already. We will now move on. We will solve question number 8 and 9 a little later, guys. मतलब in the next class थोड़े बड़े beta वो. Question number 8 and 9 beta we will do a little later. We will now start off beta with question number 11. Question number 11 beta. Yes guys, I hope you're all done with this. We will now solve question number 11 beta. We will now solve question number 11, guys. That will be the last question beta that we're discussing today. ठीक है? I'll see if I will want to give some homework question, guys, and ठीक है, decide करेंगे, guys. A manufacturer has two divisions, guys, division A and division B. Division B beta produces components that are used by both division A as well as external customers. So यहाँ पे बेटा division B, guys, is the transferring division or the selling division. Division A beta is the procuring division. The annual production capacity of division B beta is 1 lakh units. The division operates at full capacity with no inventory at the beginning, guys, and at the end of the year, guys. It sells its components beta to external customers at rupees 4,000 per unit. The variable cost of production for the component beta is 2,750 rupees. Internally, beta, it transfers components to division A, factoring any opportunity cost, beta, in the form of lost sales. When they say, guys, factoring any opportunity cost in the form of lost sales, if there is spare capacity, transfers will be made at variable cost. If there is no, this is basically transfers are being made at minimum transfer price. Minimum transfer price, guys. When they say, guys, internal transfer price beta factors opportunity cost, it basically means that internal transfers beta is at minimum transfer price. Total sales of division B beta were 36 crores, out of which beta sales to external customers beta was 20 crore rupees. As per the company's policy, the demand from Division A has priority over external customers. This year, there was an additional demand from external customers, guys, for 18,000 units. This part is very, very important, guys. This part is very, very important. As per the company's policy, guys, the demand from Division A has priority over external customers. This year, there was an additional demand beta from external customers for 18,000 units. However, since Division B operated at full capacity, this had to be turned away. You're required to analyze the sales in terms of rupees and units made by division B beta to both external and internal customers. When they say analyze as such, guys, you will have to bifurcate how many units, guys, were sold to external customers, how many units were sold internally as such beta, and what price were they sold, what was the amount of opportunity cost included in that. Recommend the transfer pricing range that would promote goal congruence between divisions A and B. Discuss the effect of changes in external demand on the transfer price for the company, assuming the current policy continues. Question simple as sir. You will obviously, guys, go through this. You will go through this but for a minute, and then we will collectively do it, guys. We would be collectively doing it as such, guys. It's a simple question, guys. No complications. I hope you're all reading the question, guys. It's a nice question, guys. I wouldn't say very interesting. It's just reverse calculation better. I would be very happy as such, guys, if you can do it. Hello guys, I think I gave you a lot of time guys. If you want better, you can please pause the video guys and try to finish off the question on your own guys. Try to finish off the question on your own. I would want you to understand the question better first. I would want you to understand the question. Forget the answer as such guys. यहाँ पे बेटा division B guys is our division B beta is selling or transferring division. Division B beta is selling or transferring division. And division A beta, division A guys is the purchasing or receiving division. Receiving division. Okay. What is most important beta to understand here is that internal transfers factors opportunity cost. When they use a word like this, what do you understand? Internal transfers factors opportunity cost. Internal transfers factors opportunity cost. That means beta internal transfer price. That means beta your internal transfer price will be equal to minimum transfer price. Internal transfer price beta will be equal to minimum transfer price guys. Minimum transfer price. Minimum transfer price will be beta two things. If transfers are made out of spare capacity, if transfers are made out of spare capacity as such guys, I'm just trying to give you an understanding of the question beta. Minimum transfer price guys will be equal to variable cost, and that is given in the question beta as 2750 rupees. 2750 rupees guys. If transfers are made beta by reducing external sales, you are reducing external sales as such guys, and that is why you're making a transfer. It will be minimum transfer price beta will be equal to variable cost per unit guys plus contribution per unit. Contribution foregone beta 2750 plus 1250 4000 rupees. This is the basic information that we need guys. Based on this beta we will be able to solve all the three bits there. Without understanding this beta we are not going to get the answer. Most important thing is this beta. Only by doing this beta I will know what exactly was the external demand beta that we had to forego. See guys, the question is very clear that we are operating at full capacity. 1 lakh units as such, but priority is being given to internal sales. Priority is being given to internal transfers as such guys. ठीक है. So what is our maximum possible external sales as such guys? वो सब के basis पे बेटा we will get the answer. ठीक है sir. ये copy करो guys. I copy this guys and I'll present you the answer to the first bit. All of you बेटा copy this. Then I'll present you the answer to the first, second and third bit. I hope you're all doing this guys. I hope you're all doing this. Yes guys. Let us move to the next part beta here. I hope you're all done with this beta. Now let us look at the first part. It says analyze karo beta. He says analyze, guys. The wording used is analyze beta instead of directly writing. You know, guys, we will write in the form of sentences. Okay, guys. The first thing, remember beta, priority as such, guys, should be given to internal transfers. Priority beta should be given to internal transfers. Okay, should be given to internal transfers. Understood, sir? The total revenue beta from external sales is, if you want, you can listen, guys. The total revenue beta from external sales beta is 20 crores. 20 crores at a price of 4,000 rupees per unit. 4,000 rupees per unit. Therefore, the number of units sold in the external market, the number of units beta sold in the external market as such beta would be, so this 20 crores as such, guys, divided by 4,000 rupees, 50,000 units. 50,000 units. Please understand, guys, question mein bola hai beta that your revenue from external sales is 20 crore rupees. So yes beta, you're selling 50,000 units in the external market. Production capacity beta is 1 lakh units. Production capacity is 1 lakh units beta, and there is no spare capacity. And there is no idle capacity, guys. We are utilizing our capacity fully as such, guys. So guys, internal transfers beta, if you are utilizing your capacity fully as such beta, internal transfers beta will be for 1 lakh minus 50,000, guys, that is 50,000 units. Yes or no? Yes sir, internal transfers as such beta would be for 50,000 units. 50,000 units. Correct, sir. Now guys, it is not that beta the entire 50,000 units as such beta have been transferred at. It is not that beta the entire 50,000 units beta have been transferred at variable cost as such beta. Few units have been transferred at variable cost. Few units beta would have been transferred at 4,000 rupees. Because guys, we have taken opportunity cost. ठीक है? कैसे करोगे बेटा इस? How will you do this as such beta is? The revenue beta. The revenue, guys, from internal transfers is 16 crores. 16 crores as such, guys. So our average transfer price per unit beta, the average transfer price per unit, sun lo ghado, would be 16 crores divided by 50,000 units. 16 crores beta divided by 50,000 units, guys. 3,200 rupees. 3,200 rupees. So I would say beta that this includes variable cost. Yes or no? This includes variable cost of 2,750 per unit. This is average transfer price beta. Contribution foregone beta. Contribution foregone would be 450 rupees per unit, guys, into 50,000 units. Into 50,000 units. Average transfer price के basis पे बेटा contribution foregone is 450 rupees per unit on an average basis, guys. That into 50,000 units बेटा 450 rupees per unit into 50,000 units, it is coming up to 2 crores 25 lakhs. 2 crores 25 lakhs बेटा. What I want you to understand, guys, is the contribution per unit beta from external sales. Contribution per unit from external sales beta is how much? From external sales. Please understand, guys, please do not copy. It is 1250, guys. Therefore, what is the reduction in external demand? The reduction in external demand as such beta would be reduction in external demand. We have foregone a contribution of 225 lakhs beta, and per unit, guys, we know that it was 1250 rupees. So that is 18,000 units. 18,000 units beta is the reduction in external demand. That 18,000 units would have given us a contribution of 225 lakhs that we are trying to recover from internal transfers. Reverse calculation. Sir, I do not like this calculation, sir. I do not like this calculation. Alternatively beta, let X be out of spare capacity. Let X be out of spare capacity. Okay. X units be out of spare capacity beta. Therefore, 50,000 minus X will be by reducing external sales. Will be by reducing external sales. If you do not like this, but you can write this. Total internal transfers are 50,000 units. Let X units be out of spare capacity, and the remaining 50,000 minus X beta will be by reducing external sales. let X units beta be out of spare capacity. So the remaining 50,000 minus X beta will be by reducing transfer price. Now X into 2750 plus 50,000 minus X into 4,000 rupees should give us 16 crores. Few units beta will be transferred at 2750. Few units will be transferred beta at 4,000. At 4,000 rupees. Yes or no, guys? All of this beta would give me 1250x is equal to 4 crores. $50,000 beta minus X into 4,000 rupees. Few units beta been doing at 4,000. And few units as such, guys, at this. $2,750, you know. And the remaining units beta at 4,000 rupees. So the overall revenue beta from internal transfers as such, guys, should be 16 crore rupees. Should be 16 crore rupees. Yes, sir. Can't get this calculation. 50,000 into 4,000 rupees minus 4,000x, 1250x minus 16 crores divided by 1250. Therefore, beta X is equal to 32,000 units. So guys, transfers out of spare capacity are 32,000 units as such, guys. So transfers beta by reducing external demand will be 18,000 units. I want you to understand this again beta. Total revenue of the organization is 36 crores, out of which 20 crores are by external sales and 16 crores beta are by internal transfers. You actually sold 50,000 units in the external market, and then beta you transferred 50,000 units internally. If all the 50,000 units beta were out of spare capacity, transfer price should have been 2,750, but then we are transferring at 3,200 on an average. The fact that we are transferring at 3,200 on an average beta would mean that few transfers were made out of spare capacity and few transfers were made beta by reducing external demand. To compute that beta, we did this. As to what is the total amount of your contribution foregone per unit, kitna contribution hai beta, and you will get what are the reduction in external demand. Or I can do this alternatively, guys, as to what is this. What is the conclusion beta is? What is the conclusion, guys? Is that beta external demand as such beta was actually 68,000 units, but external sales beta restricted to 50,000 units. External sales restricted to 50,000 units. We did not sell more than 50,000 units in the external market. Understood, sir? Usse zyada bika nahi beta. Internal transfers, guys. Internal transfers are 50,000 units. 32,000 units beta out of spare capacity. There is no opportunity cost. Out of spare capacity beta at 2,750. At 2,750. 18,000 units beta by reducing external sales. By reducing external sales. And that by reduction of external sales as such beta would mean that at 4,000 rupees. This is what you'll have to understand, guys. This is the final conclusion of the first bit, guys. Of the first bit. Yes, sir, we understood all of this. Then please copy beta. Copy, guys. Guys, this is the last question, guys. You know what I do in the last question? I ask you to pause and copy. And I'm sure, guys, that you guys will not mind it. Please pause and copy, guys. Pause and copy this, guys. 1, 2, 3. Pause and copy. Done? Yes, sir. Here, beta. 1, 2, 3. Pause and copy. Copy both the alternatives, beta. Done? I'm slowly scrolling down. 1, 2, 3. Pause and copy. Pause and copy, guys. Yes, sir. Done, sir. Okay, beta. Good. 1, 2, 3. Pause and copy. Pause and copy. Guys, we're done with the question, guys. Almost. I hope you all understood this beta. Ye reverse calculation meko chahiye beta. As in, I want you to understand this reverse calculation. That boss 16 crores mein se average transfer price is 3,200. Variable cost is 2,750. Now, whether you transfer out of spare capacity or whether you transfer by reducing external sales, you're anyways going to incur variable cost of 2,750. Our overall contribution foregone per unit is coming up to only 450 rupees. That means we are not foregoing contribution on the entire 50,000 units. We did only on a part of units. So 450 rupees into 50,000 units, but our contribution foregone is so much. Yes or no? 225 lakhs. That 225 lakhs divided by 1,250 rupees per unit, we actually reduced our external demand by 18,000 units. Understood, sir? Abhi beta, all of you read the second bit. Recommend transfer pricing range beta. Transfer price range. We guys are experts beta in this. ट्रांसफर प्राइस रेंज एज सच बेटा recommend कुछ नहीं है बेटा. ट्रांसफर प्राइस रेंज में सच गाइस फॉर 18,000 यूनिट्स गाइस ट्रांसफर प्राइस बेटा will be equal to 4,000 rupees. 4,000 rupees. Transfer price as such beta will be equal to 4,000 rupees. There is no if, there is no but beta, because your minimum transfer price itself is your external price beta. This is by reducing external demand. This is by reducing external demand guys. So obviously beta your minimum transfer price itself is 4,000 rupees. There is no if, there is no but. For 32,000 units guys, for 32,000 units transfer price beta can range from 2750 beta to 4,000 rupees. 4,000 rupees. Assuming that beta other division can buy from the external market at 4,000 rupees. Assuming beta the other division will be able to buy from the external market guys at 4,000 rupees. Division A beta can procure from external market at 4,000. At 4,000 rupees. Are we all clear about this? Yes, sir. Please make a note of this beta. Simple question beta. Once you're done with the second bit guys, all of them, all the others beta are simple. All the others are simple. Pause and copy this beta. 1, 2, 3. Pause and copy. 1, 2, 3. Pause and copy. Yes, sir. Done. Third bit देखो बेटा here. It says what will be the discuss the effect of changes in external demand beta on the transfer price for the company assuming the current policy continues. Current policy beta is pricing your transfer prices beta based on opportunity cost. Based on opportunity cost. Please understand guys. As the external demand increases beta, you guys are experts beta in this. As the external demand increases, the opportunity cost will increase. The opportunity cost beta will increase. The opportunity cost beta will increase. The transfer price beta will be the average transfer price. Average transfer price beta will be closer to 4,000. Will be closer to 4,000. Will be closer to 4,000 guys. As the external demand is increasing beta, there will be opportunity cost beta that is increasing. More number of units beta will be transferred. More number of units beta will be transferred at 4,000. जैसे beta question says external demand beta is increasing by 18,000 units. External demand beta is increasing by 18,000 units. अच्छा वो तो नॉर्मल ये बेटा वो पहले का ही है. हाँ ठीक है. So guys, as you keep increasing the external demand beta, obviously opportunity cost will increase and this will happen. You just have to write beta, nothing else. ठीक है. Okay sir, please pause and copy this as well guys. Pause and copy this as well beta. I hope you're all done with this guys. I hope you're all done with this beta. We will be solving a lot of examination questions as well. Okay guys, I will wind up the session here guys. I will not give anything as homework beta today. From tomorrow's class definitely guys I'm going to give homework. Definitely beta, because the questions can be a little lengthier as such guys, so we might have to solve homework questions as well guys. Okay. Yes sir, that's it. I'll see you guys in the next class beta. Bye bye. Take care. Keep studying. Keep revising on a continuous basis. Be disciplined. Be sincere. You cannot skip classes. You will have to put in effort no matter what happens beta. Like how guys, you should have clear cut priorities as such beta. Priority number 1, health. We all do not take care of it beta, but yes, even I do not. Everyone else doesn't, I believe guys. But priority number 1, health. Priority number 2 as such beta, or I would say equal priorities as such guys. Equal priorities, work and studies. If not studies guys, if you are not prioritizing studies over work, at least equal guys. Equal का मतलब ये नहीं होता बेटा that you give preference to work first as such guys and then you give preference to your studies. ठीक है? Yes sir. Bye bye beta. I'll see you guys in the next class. Keep studying guys.